Welcome, dear traders. You are watching a recap of the Asian session. Asian stocks and bonds were up in the morning following a rise in Wall Street. The S&P 500 and NASDAQ have reached record levels since April 2022, and the US dollar saw a sharp decline as unexpectedly low US inflation figures fueled hopes for the end of the tightening cycle. The yen, which has been under strong selling pressure due to Japan's ultra-loose monetary policy, moved up by more than 4% in recent sessions. The Australian and the New Zealand dollar were also in the black amid the bearish outlook for the greenback. Asian shares added gains even despite weak macro stats from China. In the morning, China revealed its imports and exports data. Both indicators showed a bigger than expected decline. It signals a further contraction in the world's second-largest economy. Imports fell by 6.8% in the annual terms in June, versus the forecast reading of 4%. In May, the figure was 4.5%, and this was the fourth consecutive monthly decrease caused by worsening domestic demand. Exports shrank by 12.4% after falling by 7.5% in May, logging a dip for the second month in a row and the sharpest drop since February 2020. The latest data turned out to be worse than the consensus estimate of 9.5%. Global demand was not strong enough to boost exports. For instance, exports to the United States slipped by 23.73% compared to the previous year. A drop in June was the worst in the 3 years, and China's markets were still unable to recover in the second half of the year, partly due to high inflation in advanced economies and to geopolitical challenges, a Chinese customs official said at a press conference on Thursday. Meanwhile, shares of China's tech giants listed in Hong Kong rose by 3.4% after the chief executive urged companies to support the slowing economy. The MSCI Asia Index grew by more than 2%. Its rise was facilitated by a 2.5% jump in the Hang Seng Index and a 1.6% increase in Australian commodity stocks. The Nikkei Index also advanced by 1.4%. Asian stocks gained ground following a jump on Wall Street. Sentiment has improved markedly as the traders are beaten at the end of a monetary tightening. Slowing inflation could convince the Fed that there is no need for new rate hikes. It may ease financial pressure on the companies and stimulate a rise in their shares. Markets see a 92% chance of a 25 basis point rate increase at the policy meeting on July 25 and 26, according to the CME's FedWatch tool. At the same time, the likelihood of a rate increase in September dropped to 12.9% from 22.3% a day earlier. On Wednesday, the Beige Book was also published, showing weak economic growth in the United States at the end of May and in June. Economic expectations for the coming months point to sluggish growth, the Beige Book stated. US macro stats published yesterday caused sharp volatility in the markets, and the reaction was quite strong. Some analysts noticed that a decline in inflation is certainly good news. However, it might be premature to expect a policy reversal. Markets may overestimate the likelihood of a rate cut after upbeat inflation data. Yet these doubts will hardly help the greenback recover, and the US dollar extended losses in the Asian session after a dramatic decrease yesterday. Traders are confident that the regulator will soon ease policy given the fresh inflation figures, and the US dollar looked at the worst 5-month session, plunging by 1.2%. It broke through the support level of 101 points and 180, the low of 2023. A downward scenario looks more likely at the moment, and the greenback could slide to lower levels and eventually reach the key level of 100 points. Despite improving inflation data, policymakers stick to hawkish rhetoric. They have said more than once that the fight against inflation is not over. A fall in the US dollar of more than 12% from the September peaks could create extra inflationary pressure, and this will hardly be an argument for rate cuts. The yen appreciated by 4.8% against the US dollar in 5 trading days, and by almost the same amount versus other rivals as the short-term sellers closed their positions. The majority of investors expect the Bank of Japan to change its stance in the near future. In the Asian session, the USD JPY pair rebounded from 138, trading at 138.60. Risk appetite and oversold status on the early charts are forcing speculators to close short positions. However, the bearish sentiment and expectations of a policy reversal by the Bank of Japan impacted the trajectory of the USD JPY pair. A further decline in the yield of the US Treasury notes will continue to affect the US dollar and limit the upside potential of the dollar-yen pair. Those speculators who are betting on a further growth should be more cautious. It would be wise to wait for a significant increase in the long positions, and it will indicate that the price has hit a short-term bottom. The AUD-USD pair advanced by 0.4% in Asian trading, breaking through a 0.6400. The Australian dollar maintained its rally, logging the biggest growth in the last 5 months. The main driver for such a move was the expectations of the end of the tightening cycle by the Fed and even a possible rate cut in the near future. The yield on Australian bonds declined. Investors believe that the Reserve Bank of Australia will hardly hike rates, especially in August. Futures now imply only on a 37% chance that the Reserve Bank of Australia will raise its 4.1% cash rate next month. The AUD-USD pair reached a 3-week high of 0.6810, having notched the biggest intraday gain of 1.5% since January. Australia is among China's largest suppliers of commodities, and the latest negative data from China have reinforced concerns about a likely slowdown in economic expansion in China. It may cause a fall in the AUD-USD pair. The New Zealand dollar was also gaining momentum. It grew above 0.6300 on Thursday, and the NZD-USD pair reached 0.6330, climbing by 0.6% in the morning. Apart from the US data that boosted the rally, investors digested the Reserve Bank of New Zealand monetary policy results. As widely expected, the regulator kept the interest rate unchanged. Nevertheless, the main driver for the New Zealand dollar is the likelihood of new rate hikes by the Fed. The weakening of the US dollar across the board boosted a rise in the NZD-USD pair. The Kiwi still has an opportunity to break through a 0.6345. In the short term, the pair may move to the resistance level of 0.6385, and the support level is located at 0.6280. Traders also analyzed the domestic economic data, which was rather grim. The manufacturing PMI index fell to 47.5 points in June from a 48.9 in the previous months. This is the 4th consecutive month of a contraction in the manufacturing sector, and the sharpest slide since November last year. The main reason for the drop was a decrease in demand. Now, market players are focused on the US economic data, namely the producer price index and weekly initial jobless claims. Traders are looking for short-term trading opportunities. And that's all for now. Hit the subscribe button and stay up to date with the latest market news. And see you soon!